Hello everyone. Good afternoon. I am CA Heenal Furia on behalf of the Women and Young Members Excellence Committee of ICI. I welcome you all in the Sky High Symposium Series 65. At Sky High Symposium is a Wednesday series of program conducted by the Committee for the Women and Young Members. It is one of the Women and Young Members Excellence Committee's initiative to not only disseminate information to members on technical updation and non-technical skills, but also to empower and inspire them to come at the forefront and realize their verbal skills at public forum. Today, we are going to cover the session on international NRI international taxation. And I can see Preeti ma'am has joined us. So let us give a warm welcome to Preeti ma'am. She's the chairman of the council. Preeti ma'am, would you like to say a few words?
Sure.
Yeah.
Thank you, Ginal, for inviting me and welcome all of you, my dear friends who are there on the session. And today we have, I think, 60, which 65th session today we have. So since last 65 Wednesday, we are interacting with all of you. And today we have with us CA Prerna Pishori as a speaker and CA PT Tarot. And my dear friends, I can see Kamla, Hinal, Pravina, and all my dear friends as coordinators to moderate the sessions. So welcome all of you friends. And today we have management committee meeting going on at present at ICAI, and where one of the agenda item is for the women awards. And hopefully we have worked a lot for giving the women awards, and it has to pass through this management committee meeting. So I am attending that in between attended this. So friends, I hope gaining the knowledge through these sessions. And if you want to be the part of as a speaker or speaker, feel free to connect with me at any point in time. And a lot of other activities are going on. We have various sessions on physical mode also. You can join anywhere. We have upcoming RRC at Goa on 13th and 15th of August. We also uh, have a program on 26th of August at Jaipur. Various other programs are lined up. So friends, stay tuned and block your calendar with Sky High Symposium every Wednesday 4 to 6. With these words, once again, I welcome all both my dear speakers or moderators and all my dear participants. Thank you so much. Stay in touch.
Thank you so much, Preeti ma'am, for the kind words. Now let's start with the session one. I'll just give a brief introduction to the speaker. The first session is on taxation for NRI, and we have a very learned speaker with us, CA Prerna Pishori. She is a chartered accountant and international tax lawyer. She's a partner at Pishori, Panchori, and Jain. She has experience in taxation advisory, transfer pricing, cross-border transaction advisory, and structuring. She also deals with a lot of startups, litigations, etc. She has completed her master's from WU Vienna as Foundation for International Tax Scholar 2019. She has delivered lectures on various professional forums like us. She's been teaching international taxation law to the chartered accountants and advanced diploma in international taxation UK students. She's also been selected as the 35 future leaders in taxation by TaxCom. She's also authored many papers and books on international taxation. She's also been awarded the International Research Award by ICAI. And she's a convener of International Studies Committee at CTC and IFEA and BCAS. So let's give a warm welcome to CA Prerna. Prerna, you may start with your beautiful session. Thank you so much for coming as a speaker on this forum.
Yes, thank you so much. I'll just share my presentation. So hope my presentation is visible.
Yes, it's visible. Yeah.
Thank you so much for inviting me. Thanks, Preeti ma'am, and thank you for this particular session. We'll just quickly start with this. Since we have 1 hour time for the NRI taxation, which is like a very, very huge topic in itself. So we are going to briefly touch upon several aspects of NRI taxation. First of all, about the residential status. How do we determine whether a person is the resident or non-resident, and why is it important to determine that particular residency status? So, in order to first determine that whether a person is resident or non-resident, we have the number of days or the stay condition which has to be met. That is, the person should be in India for more than 182 days in the financial year, or he should have been present in India for more than 60 days in a particular financial year, and for 365 days in the preceding 4 years. So any of these conditions, if it is satisfied, that person will become a resident in India. Now, if a person is going outside India for the employment, or if person is coming in India, not every person, but the Indian citizen or the person of Indian origin. So an Indian citizen leaving India for the employment will also include self-employment. For him, the 60-day condition will not be applicable. The 182-day condition will become applicable. Similarly, for a person visiting India who is an Indian citizen or a person of Indian origin means the parents or the grandparents were Indian citizen at any point of time. So in that particular case, for him as well, the 60 days would be replaced with the 182 days. So 60-day condition basically will not apply for any Indian citizen going outside India for the employment, or any Indian citizen coming to India for the visits. Now, there is another residential condition which is put up, or the stay condition, which is that if the Indian citizen or a person of Indian origin has the income from the Indian sources more than rupees 15 lakh, is coming on visit to India, for him the 182 day rule will not be applicable. So as I said, that if the Indian citizen or PIO is coming to India for visit, then 60-day condition is not applicable. 182-day condition is applicable. But his income, his total income from the Indian sources should be less than rupees 15 lakh. If it is more than rupees 15 lakh, then instead of 60 days, we have to consider 120 days. But at the end, he would be considered as the resident and not ordinary resident. So there are two kinds of resident. If you fulfill any of the basic condition, you become resident. But you need to also check whether you are an ordinary resident or you are a not ordinary resident. So ordinary resident is one who fulfills the two additional conditions, and not ordinary resident is one who does not fulfill any additional condition or fulfills either of the additional condition. Now, a person is an ordinary resident if he is a resident in India in 2 out of 10 preceding previous years, preceding the relevant financial year, and he is present in India for 730 days or more during the last 7 financial years. Excluding the current year, in the last 7 financial years, he has been present for 730 days or more. If you fulfill both these conditions, you would be considered as ordinary resident. Otherwise, you are a not ordinary resident. And for the person whose total income exceeds 15 lakh and who is coming on visit to India, who is an Indian citizen or PIO, he will be directly considered as not ordinary resident. For him, you do not need to check any additional conditions. He is a not ordinary resident if he has stayed in India for more than 120 but less than 180 days. For him, you don't have to check any particular additional condition. Now, what is the difference between the ordinary resident and not ordinary resident? For the ordinary resident, the global income is taxable in India. The entire global income is taxable in India. So, whether it is income accruing outside India, whether it is income received outside India, all the income needs to be taxed in India. Whereas for the not ordinary resident, only the Indian sourced income is taxable. So that is a huge difference between the ROR and RNOR. The ROR, only the global income is taxable. For RNOR, only the Indian sourced income is taxable. Now you would ask the question that why there is a difference between RNOR and NR. Even for NR, only the Indian sourced income is taxable. Then why do we have a separate category of RNOR? So there's a difference between RNOR and the non-resident. A not ordinary resident is different from non-resident. How? A not ordinary resident will be taxed at the rates which are applicable to a resident. He will not be taxed at the rates which are applicable to a non-resident. For the non-resident, there are separate rates of tax. For example, for dividend, interest, royalty, technical services, the lower tax rates are prescribed. The non-resident can access the tax treaty, whereas the not ordinary resident will be taxed as per the Indian law. He would not be eligible to get the treaty benefit because he has been now becoming the resident of India. Unless we have the tiebreaker test fulfilled under the tax treaty, which means that he, by virtue of the tiebreaker test under the tax treaty, he becomes the non-resident of India. Third, the difference between the RNOR and NR is that for RNOR, one more income is taxable in India, which is income accruing or arising outside India from the business controlled or profession set up in India. For non-resident, that income is not taxable. So if the income is accruing or arising outside India from a business or profession, but that business or profession is controlled from India or set up in India, then in that case for RNOR, that income is also taxable. One more residency has been introduced, which is deemed residency in 2020. What is that? That if the person is the Indian citizen and has the total income from the Indian sources exceeding rupees 15 lakh, and he is not liable to tax in any other country, then in that case, he would be considered as the deemed resident of India. But again, once he is considered deemed resident of India, he will not be considered as the ROR. For him, we do not need to check any additional conditions. He would be straight away RNOR. A deemed resident will always be RNOR. For him, it doesn't matter how many days he has come to India. If he is not liable to tax in foreign country, but he is a citizen of India, having total income from Indian sources more than 15 lakh, he would be considered as deemed resident. So not liable to tax meaning that he is not required to pay any taxes in the foreign country because he is not a taxable person there. For example, in UAE, we do not have any taxes on the individual. So that could be considered as not liable to tax. So that is why the first and foremost thing is that it is very important to determine whether a person is a non-resident at the first place or not. Now, even if we decide that a person is a resident of India, we also need to go to the tax treaty to determine if he is a resident of other country also. And if he is a dual resident, meaning he is a resident of, let's say, India as well as US, because it is quite possible the US green card holders. The US green card holders are the resident of US because they are the US citizen. US citizens are considered as resident of US. So then in that particular case, he would become resident of India, he would become resident of US, and by virtue of that, he would be taxed in both India and US. So we need to go to the tiebreaker rule under the tax treaty to determine where exactly he is the resident. So tiebreaker rule under the tax treaty gives the several conditions or gives the several tests, which is where is the center of vital interest, where are his personal and economic relations more closer. His personal and economic relations are closer to which country, whether India, whether US. Then you have to identify where is he having the habitual abode, where is he likely to stay, where is he likely to settle back. All those questions need to be answered. Of which country he is having the nationality, where is he having the permanent home. So all those questions needs to be answered to determine in which country he tie breaks finally, and that country will be considered as his resident country. Next important concept for the non-resident is that for a non-resident, as I said, that income will be taxed in India only if it is received in India or it is accruing or arising or deemed to accrue or arise in India. Now, income received in India or income accruing or arising or deemed to accrue or arise in India. Only that income will be taxable in India. Now, what do we mean by income accruing? Accruing means that income having the source in India. A direct connection. The income is emanating from the Indian source. Now, Section 9 provides for the deemed accrual. Section 9 provides for the deemed accrual of the income. Now, if we look at Section 9 of the Income Tax Act, Section 911 talks about the business connection. So, income of a non-resident is deemed to accrue or arise from or through the business connection in India, or from the property or any asset or source of income in India, or a capital asset situated in India. So for a non-resident, the deemed accrual is provided under Section 9. So Section 911, as I said, talks about the business connection, the asset, property, capital asset, property, or the source of income in India. Now first let's talk about the term business connection. What do we understand by the term business connection? Business connection is a very, very wide term. It means it is not defined in a comprehensive manner. It is defined very loosely in the Income Tax Act. So explanation to the Section 911, explanation 2 to Section 911 provides that the business connection includes. So few examples are given for that, but business connection can include many more things. It's a very wide term. However, what business connection actually means is it has been interpreted by various judicial decisions. So what does exactly business connection include? So that we have to understand looking at the several judicial decisions. And it has been defined to include the connection which is there with the income basically. So it should not be an isolated transaction. It should not be an isolated transaction. So we have to see that there is the connection between the income which is earned with the particular source of income. But it's like a very wide concept. So the non-resident which is there, the non-resident would be taxed in India or liable to tax in India if there is a real and significant economic nexus. There has to be real relation between the business activities carried out by the non-resident and the activities within India. And that activity should contribute to the earning of income by the non-resident. And it has to be a continuous exercise. There has to be continuity. A business denotes some amount of continuity, and isolated transaction cannot be a business connection in India. So explanation 2 to section 911 provides that the business connection includes any business activity carried out by the non-resident through a person who is a dependent agent of that non-resident, who is a dependent agent of the non-resident. So, a dependent agent of a non-resident can constitute the business connection in India. Now, who is a dependent agent? Who habitually exercises in India authority to conclude the contracts on behalf of the non-resident, or habitually plays the principal role leading to the conclusion of contract. If I am concluding the contracts on behalf of non-resident, or even if I am not concluding, but I have been playing the fundamental role or the main role leading to the conclusion of contract. Let's say I'm negotiating the prices, I'm negotiating with the customers, I'm dealing with the customers, I'm kind of finalizing the orders, the quantity and everything, but it's just that the orders are signed by the foreign company. So virtually I'm doing everything, but I'm not just concluding the contract. In that case also, I would be qualified as a dependent agent, and that would lead to business connection. Or the agent is one who is maintaining in India the stock of goods from which he regularly delivers the goods on behalf of the non-resident, or secures the order for the non-resident. So in all these cases, the business connection would be constituted. So if I maintain the stock of goods and make the delivery therefrom, or I secure the order, then in that particular case, I would be considered as a dependent agent, and this would lead to the business connection. However, there is an exception to that. The exception is that the business connection will not include any business activity which is carried out by the person who is of the independent status, and he is exercising these activities or these duties in the ordinary course of the business. So if a person is of the independent status, he is not just confining his activities only for one non-resident, but he has been regularly doing that for several companies, then he would be considered as the independent agent, and therefore that would not constitute the business connection for the non-resident. So business connection will be constituted only if the agent is the dependent agent. Secondly, if let's say for example, I have the business connection which is constituted. Let's say I'm making the sales in India. Now that leads to the business connection in India. Let's say for example, there is the Netherlands company which is importing the goods from India. Now, let's say it is appointing the agent in India. Now, that agent is supervising the execution of the contracts when the goods are being imported by that particular, let's say, Netherlands company. So, Netherlands company is importing certain raw material, procuring certain raw material. Now, let's say the agent is involved in the procurement of raw material. He's supervising the execution of the contract with respect to, let's say, the quantity, the quality of the goods, let's say the proper supply of the raw material. Whether there will be business connection, the answer is yes. There will be a business connection in that case, because there is a systematic engagement of the non-resident in India, and he is earning the income therefrom. So therefore, in that case, there will be the business connection in India. Now, if there is a business connection in India, whether the entire profits are attributable, whether the entire profits of the Netherlands company are to be taxed in India, the answer is no. Only the profits which are attributable to the operations carried out in India. So, not the entire sales of the Netherlands company will be taxed in India. Only the profits which are attributable to the agent's activity in India. So, the agent which is there is the dependent agent, and therefore there was a business connection. Now the profits which are attributable to the agent's activity will only get taxed in India. Because understand the thing that the entire sales which are there are not the result of the agent's activity. The sales are the result of several other factors. The Netherlands company would have done certain marketing. There would already have been certain goodwill of the Netherlands company. There would already have been the relationships of the Netherlands company because of which it is generating the sales. It is also because of the quality of the products which the Netherlands company is making. So therefore, it is not necessary that it is only because of the agent's activity that the sales are getting generated. And therefore, the entire sales from India cannot be taxed in India entirely. So only the profits in relation to those sales has to be attributed to India. Now, not the entire profit. Let's say, for example, if I'm making the sale of 100 rupees, my profit is, let's say, 20 rupees because my cost was 80. Now, these 20 rupees of profit cannot be taxed in India in entirety just on the basis that sales are concluded in India. No, because the profits are the result of the supply as well as demand. So, supply side is in Netherlands. The manufacturing, the advertisement, marketing, finance, all of that is being done in Netherlands. The profits are the combined result of the demand as well as supply. It cannot be entirely attributed in India. So what portion of 20 will get attributed in India? That needs to be determined as per the profit attribution principles. So rule 10 gives us the answer as to how the 20 rupees have to be attributed in India. But what section 911 clearly says is that only the profits which are attributable to the operations carried out in India. In our case, the operations carried out are by the dependent agent. So the profits which are attributed to that particular agent's activity will only get taxed in India. So not the entire profits are to be taxed in India. So that is the business connection what we were talking about. The next one, as I said, was the property or asset or source of income in India. So section 911 also provides that income arising from the income arising or accruing or arising whether directly or indirectly through or from any property in India. Now property could be anything. It could be the rights. It could be any movable property, immovable property, any property in India, or through or from any asset in India, or the source of income in India. So any income arising from any source of income, any property, any asset will be deemed to accrue or arise in India. Third is through the transfer of a capital asset situated in India. Now, under the property asset, it could be the rental income. Let's say, for example, there is a non-resident who is earning the rental income from the immovable property. He has given the immovable property on rent. He is earning the rental income that will get taxed in India because it is from the property located in India. Or let's say, for example, he is earning from some intangibles, some licensing he has done of the patents, and therefore that income, the patents are the Indian registered patent, then therefore the income, licensing income will be taxed in India. It will be deemed to accrue or arise in India. Then through the transfer of a capital asset. Let's say, for example, if there's a non-resident who sells the property in India, he would be taxable in India, and therefore there will be the tax liability in India because that income is deemed to accrue or arise in India. So transfer of any capital asset, be it the shares of the company, mutual funds, any residential house property, commercial house property, it will be taxed. Now, you would say that is a position under the income tax law. What about the tax treaty? Under the tax treaty, again you have to look. So first you need to examine from the act, and you don't have to stop there. Now under the act, let's say for example, I have the business connection. I need to go to the tax treaty. Under the tax treaty, the equivalent of the business connection is the term permanent establishment. Now, permanent establishment is a very well-defined concept. Permanent establishment is a very well-defined concept. The permanent establishment, why is it narrower as compared to the term business connection? Because it's a very defined concept, as I said. The permanent establishment includes the fixed place is permanent establishment. Fixed place permanent establishment means that there is a fixed place of business through which the non-resident entity is carrying out the business. There's a fixed place. There's a fixed office. There's a fixed establishment. There could be any fixed place. It could be anything. It is not just restricted to any office. It could be anything. It could be a stall, it could be exhibition center, it could be even the golf course. There have been judicial precedents on that. So any fixed place of business through which the non-resident is carrying out the business activity in India, that will be a fixed place P. Secondly, permanent establishment includes the construction P. Construction P meaning that the construction activities are being carried out for a certain number of days in India. That constitutes the construction P. Installation P, the installation activity for the erection of machinery is being carried out for a certain number of days. That constitutes the P. Then, if the non-resident is rendering the services in India through the employees, so let's say secondment contracts are there, wherein the employees are deputed to Indian organization for carrying out certain services, that will constitute the service fee. That will constitute the service fee. So if the employees are present rendering the services for the non-resident for so and so days, that will constitute the service fee. Then there is again dependent agency fee. What we have it under the Act is similar to what we have under the tax treaty as well, the dependent agency fee. So the P is a very defined concept compared to the business connection. Business connection just says that it includes dependent agent. It doesn't say much. But P has the list of inclusion and the exclusion. Like from the P, preparatory and auxiliary services are excluded. If the services are in the nature of preparatory function or ancillary function, support function, all that are not considered as P. So there are specific inclusions and exclusion. So you need to check first under the income tax law that whether there is a business connection or not. And secondly, you have to go to the tax treaty to see that whether there is a P or not in India. Most of the cases you would say that okay, there is no P because as I said, the P is a defined concept and only if the conditions are fulfilled, you will say that there is a P in India. If there is no P in India, then in that particular case, we will not have the taxability in India. So by virtue of the tax treaty, you are coming up. Similarly, if you are talking about the sale of property or income from property, in most of these cases, with respect to let's say the income from property, any income from the property or any asset, so that will depend on the type of asset. Let's say if it is from immovable property, let's say we are talking about rental income. The rental income, even under the tax treaty, most of the tax treaty give the right to the source state where the immovable property is situated. So in that case, even in the treaty, you will be having the source of income in India. With respect to the transfer of a capital asset, if the capital asset is again immovable property, most of the tax treaty will give the taxing right to the country where the immovable property is located. So in that case, again, under the treaty also, you will be considered as taxable. So you will not get any relief. But if let's say there is the case of the shares of the Indian company are being sold, or the mutual funds of the Indian company are being sold. So then in that particular case, what will happen is that the tax treaty sometimes may give you the relief in terms of the taxability because many of the tax treaties provide that the sale of the shares will not be taxable in the source country if certain conditions are satisfied. If the ownership is more than 50%, like there are several treaties which gives these conditions. Sometimes the treaties provide that even in the case of sale of shares, the source state will have the taxing right. So you will have to look into the treaty to treaty as to what are the conditions. So first you have to examine from the perspective of the act, and then you need to go to the tax treaty to see if there is actually the taxability in India or not. But for accessing the tax treaty, you also need to see that you have the tax residency certificate. Without tax residency certificate, it is difficult to gain the treaty relief. Because the treaty provides the relief only if you are a resident of either of the contracting state. So either you should be the resident of India or you should be the resident of the country with which the treaty has been entered into. If you are resident of none of these countries, you cannot claim the treaty benefit. And now how do you prove that you are a resident of, let's say, if you are looking at India-US tax treaty, how do you prove that you are the resident of US? Because let's say you have income from India. Let's say you have the business income from India. You have income from the sales generated in India. How do you say that as per the treaty, I do not have the P? Okay, you do not have the P, that is fine. But how can you claim the treaty relief? Only when you are resident of US, you can claim the treaty relief. But how do you prove that you are the resident of US? For that, you need to submit the tax residency certificate. Section 90 subsection 4 provides that the tax residency certificate needs to be provided for claiming the treaty benefit. Now, what is tax residency certificate? It is issued by the tax authorities of the other country, certifying that you are the resident of that particular country for so and so period. So if you are a resident of that country, if you submit the tax residency certificate, you can gain the treaty relief. Also, section 90 subsection 5 provides that even the form 10F needs to be submitted. So TRC is mandatory for claiming the treaty relief, as well as the additional information needs to be furnished in form 10F. Now, what is form 10F? The details which are not mentioned in TRC. Now, TRC may not contain all the details. So, the additional information is required to be furnished in form 10F. If the TRC gives all the details, then it's fine. But if the TRC does not give all the details like the status of the non-resident, the period, or the tax identification number, or the address, then you need to submit the additional information in form 10F. Now, form 10F needs to be furnished online. Only in the exceptional cases. The exceptions are given. For them, the manual form 10F is allowed. But now onwards, the form 10F is to be furnished online. Are we clear? So therefore, the form 10F and TRC needs to be submitted. Now you would say, what if we do not have TRC? So the tax officers usually disallow the cases. Of course, there are judgments which say that even if the TRC is not there, still the benefit can be given. Because the TRC or obtainment or requirement cannot be an impediment to the treaty relief or to the claim of the treaty relief. So even if TRC is not there and if there is a sufficient and reasonable documentary evidence, then in that particular case, we may say that the treaty benefit should be granted. But of course, at the tax assessment level, it is very difficult to say that, and therefore, without the TRC, the claim may get rejected. The treaty claim may get rejected. So next, coming to section 9 again. The next one is 912 with respect to salaries. Section 9 also has like different source rule for different category of the income. Like as I said, for business connection, for the business income, there has to be the business connection. For the capital gains or for the rental income, it should be from a property or the capital assets situated in India. For the salaries, what is the source rule saying? For the salaries, it says that section 912 talks about the salary. And it provides that the salaries will be taxed or deemed to accrue or arise in India if it is earned in India. What do we mean by earned in India? If the services are rendered in India. If the services are rendered in India, the income will be taxed in or will be deemed to accrue or arise in India. So if the non-resident is coming in India and is rendering the services here, then in that particular case, it will be considered as deemed to accrue or arise in India. For the government employees, the source rule is that if the government pays the salary to a citizen of India, even if it is for the services rendered outside India, it will be deemed to accrue or arise in India. So for the government employee, even if the salary is for the services outside India, still it will be deemed to accrue or arise in India. For the government employee, for the non-government employee, the income will be deemed to accrue or arise in India only if the services are rendered in. For the dividend, what is the deemed accrual? Dividend, if it is paid by an Indian company outside India, so even if the dividend is paid by the Indian company outside India, it will be deemed to accrue or arise in India. With respect to interest, royalties, and fees for technical services, the source rule is more or less same. The source rule is more or less same. So what is the source rule for the interest, royalty, or fees for technical services provide? That is dependent on the payer. Who is the payer of the income? Who is the payer of the income? So that is dependent on that for interest, royalty, and fees for technical services. So if the payer is the government, then in that particular case, the interest will be deemed to accrue or arise in India. The interest will be deemed to accrue or arise in India. If the payer is the resident other than government, if the payer is the resident other than government, then in that particular case, the interest will be deemed to accrue or arise in India again. So I've written here for royalty, but it goes likewise for interest, royalty, or FTS. So interest, royalty, or FTS will be deemed to accrue or arise in India if it is paid by the government or by a resident. So if a resident payer is making the payment, the income will be deemed to accrue or arise in India. There is an exception to this. The exception is that if the payment is being made by a resident for business or profession outside India. If the payment is for the business or profession outside India. So let's say, for example, the Indian company is making the payment of interest on loan borrowed by it from the, let's say, Citibank US. So the interest income for the Citibank US will be deemed to accrue or arise in India. However, if the loan is borrowed by the Indian company, the interest is also paid by Indian company, but the loan is not for the business in India, but the loan is for, let's say, its branch in US. So Indian company is having a US branch, and let's say the loan is for that particular branch in US. So then in that case, the loan is borrowed for the business or profession outside India. Then in that particular case, the interest will not be, interest, royalty, or FTS will not be deemed to accrue or arise in India. Then in that case, it will not be for the, then it will be for the business outside India. The money are borrowed for the purpose of business outside India, and therefore it will not be deemed to accrue or arise in India. When one non-resident makes the payment to another non-resident, let's say one US company has borrowed the funds from Citibank US for the purpose of the Indian branch, and the US company is making the payment of interest to the Citibank US. That interest amount will also be deemed to accrue or arise in India, because the source rule for the interest, royalty, or FTS says that if a person who is a non-resident making payment to another non-resident, that will also be deemed to accrue or arise in India, because if the interest or the royalty or FTS is payable in respect of the business or profession carried on in India. If the business or profession, if it is for the purpose of the business or profession carried on in India, then that will be deemed to accrue or arise in India. Same goes with the royalty and same goes with the FTS as well. Are we clear? So therefore, the interest, royalty and FTS have the same source rule. How about in the tax treaty? Under the tax treaty also the source rule is given, which is again dependent on where the payer is. Who is the payer? Tax treaties do not have the payer as a government. They do not talk about when the payer is a government, it will be deemed to accrue or arise in India. That is given under the Act. But if the tax treaty says that if the payer is a resident, that will be deemed to, the income will be deemed to accrue or arise in India. So in fact, the source rule under the Income Tax Act is much narrower compared to that under the tax treaty. Because under the tax treaty, the source rule does not have any exclusion in terms of that if the business or profession is carried on outside India, the interest, royalty or FTS will not be deemed to accrue or arise in India. That exclusion is not there under the tax treaty. It is there only under the Act. So in fact, the source rule for interest, royalty or FTS is narrower in the income tax law compared to the tax treaty. For a non-resident, again, here it says under the Act that if the non-resident borrows the funds or the royalties in respect of the business or profession in India, it will be deemed to accrue or arise in India. Under the tax treaty, there is a similar source rule, except that they, instead of the term business or profession, they use the term permanent establishment. So again, the term permanent establishment, since it's narrower compared to business, therefore the source rule for the non-resident is narrower under the tax treaty in case of interest, royalty or FTS. Now interest is fine, we understand what is interest, but what is royalty? Now royalty is again very widely defined under the Income Tax Act. Under the Income Tax Act, royalty includes almost everything. Transfer of rights in respect of any patent, invention, model, design, trademarks, or imparting of any commercial scientific information, or use or right to use industrial, commercial, scientific equipment, imparting of any information concerning the working of the any equipments, or for that matter, transfer of all or any rights in respect of copyright, literary, artistic, scientific work, use of any intellectual property, or right to use any industrial, commercial, or scientific equipment. Right to use a computer software is also a royalty. Then they say that it does not matter whether the payer is in the control of the equipment or not. Even if the payer does not have the control over the equipment, it will still constitute the royalty. Right to use the satellite transmission, right to use any particular signals which are there through the cable, optic fiber, all of that is considered royalty. So royalty is very widely defined under the income tax law. Whereas under the tax treaty, the royalty is very restrictive definition is provided for the royalties. So therefore, most probably you will see that under the tax treaty, the right to use computer software is not there. Most of the litigation was around whether right to use a computer software or these computer programs or these computer softwares which you are purchasing, the customized online software, whatever, whether this constitutes the payment for that constitutes the royalty or not. Then we had the Supreme Court decision in the case of engineering analysis, wherein it has been held that for the computer software in the reseller agreement, in the end user license agreement, that will not constitute the royalty. So one needs to see how the treaty is worded, whether the treaty definition of royalty is as vast as compared to the Act, which will not be in most of the cases. Secondly, As far as the treaty definition is concerned, you cannot import the domestic law meaning directly into the treaty. You cannot say, okay, royalty is defined in income tax law and it includes computer software, so let's import it into the treaty also. No. So section 90 is very clear. It says, section 90 subsection 2 says that the act or the treaty, whichever is beneficial to the taxpayer, needs to be considered. If the act is more beneficial, you will consider the act. If the treaty is more beneficial, you will consider the tax treaty. So you have to be very careful in determining the taxability. Look at both the definition under the act as well as the tax treaty. Finally, coming to the fees for technical service. For the fees for technical services, the Income Tax Act section 917 talks about the definition of FTS. It says managerial, technical or consultancy services. However, in the tax treaty, the definition may be very restrictive. Sometimes the managerial may not be there. Sometimes the consultancy services in some of the tax treaty may not be there. Sometimes in the several treaties, we have the make available test. What is a make available test? Make available test means that if the service provider is making available the knowledge to the service recipient, only then the fees for technical services will be taxed in the source country. Otherwise, you cannot have the taxability in the source country. So let's say, for example, after this session, you are able to advise on international tax assignments, then I can say that I have made available the knowledge to you. And let's say if I'm getting some fees out of it, then only the fees will get taxed in India. But let's say after this particular session, you can still say that, okay, we may not be able to advise any on international tax assignment, and we may have to go back to the session conductor. In that particular case, I have not made available the knowledge, and therefore my fees will not be taxed in India. So that we can take a call only after the session ends. Then you can say that whether I have made available or not the knowledge. But important point is that many of the tax treaties have this particular concept of make available. So therefore, these are the restrictive definition under the tax treaty, and therefore that needs to be used. Because that is more beneficial as compared to the act. Because under act, it just says FTS means managerial, technical or consultancy service. What is managerial? Managerial means all these managerial authorities, what the fees you get for that, for exercising the management function, that is managerial service. Consultancy is very simple, but what is technical? Everything can fall under technical. So Supreme Court in Bharti Airtel, in Kotak Securities have clearly held that technical means that there has to be human intervention. Automated services cannot be considered as technical. Tomorrow you cannot say that, okay, I'm providing a computerized service. Some standard processing charges are being levied by bank. Some standard processing charges are being levied by website. Internet charges are being levied. That is not technical service. Technical services mean there has to be human intervention. Also, Supreme Court has held that it should not be a standardized service. It should be customized service. It should not be a facility. It should be a customized service. If I'm levying standard charges to everybody, let's say for telephone, for broadband, for internet, bandwidth charges, that is not something, the service. There has to be a customized service. Only then it falls within managerial, technical or consultancy. But if you look at the tax treaty definition is much narrower because it requires you to make available the knowledge. Also, you do not have to stop at the definition in the tax treaty. Because sometimes it's possible under the tax treaty, it is written that FTS means managerial, technical or consultancy. And then you may come up and say that in the treaty also it is same, in the act also the definition is same, and therefore it will be taxed in India. You also need to read the treaty holistically. You need to go to the protocol of the tax treaty to find out if there is a most favored nation clause present under the tax treaty. What is the most favored nation clause? The most favored nation clause is that India promises to the treaty country. India promises to the treaty country the country with which India has signed the tax treaty, that if India grants a favorable treatment, if India grants the favorable treatment to any other treaty partner who is an OECD member country, which is an OECD member country, let's say India promises to UK, or let's say India promises to France, that if I have a favorable treaty with any other OECD member country, so treaty is the product of the negotiation. Treaty is what? It's a contract. Contract, you have like several negotiations, right? So if India is saying at the moment I cannot give you a restricted definition because you are a developed country, I cannot give you a restricted definition, but let's say tomorrow, if I enter into a tax treaty with any other OECD member country, which means OECD member country means a developed nation only, and I give them a favorable treaty provision, then in that case, I will extend it to you as well. So for that, you need to see the protocol of the tax treaty, because the MFN clause, the most favored nation clause, is found in the protocol to the tax treaty. And by virtue of that most favored nation clause, let's say in India, France, there is no make available test which is there, but you can borrow that particular definition from India, UK, which has the make available test. India, France will not have make available test, but you can still borrow that from the India, UK treaty and tell your client that since you have not made available, this is not going to be taxed in India. So therefore, you have to read the treaty holistically for determining the taxability. Now, once you have determined whether the income is accruing or arising in India, or it is not accruing or arising, based on section 5, section 9, and based on the tax treaty provision, then comes the taxability, which is the tax rate. So the tax rates are generally given under 115A. So dividends are taxed at 20%, interests are taxed at, like for interest on rupee denominated bonds, it are taxed at 5%. Interest on loan raised in foreign exchanges are taxed at 20%. Royalties or fees for technical services, here it's written as 10, but it's 20%. So there's a correction here, it's taxed at 20%. So under 115A, you have the different taxability. But again, you need to go back to the tax treaty to see if under the treaty also same taxability is there. Because it is possible that under the tax treaty, the tax rate may be lower than that under the act. So therefore, you will apply the tax treaty rate. It is possible that you may say that as per you are going to the act for the accrual, determination of whether there is a source in India or not, for the accrual in India or not. And for the tax rate, you may go to the tax treaty. So that is very much possible. So, but for accessing the tax treaty, for claiming the treaty relief, you need to have the TRC. Also, if the payments are being made to a non-resident, section 195 needs to be applied. The TDS is there under 195, except in the case of interest, which are covered under 194 LB, LC, LD, and salaries, which is under 192. Rest of the payments are usually covered under 195. So if the payer is a resident, or if one non-resident is making payment to another non-resident, the TDS needs to be deducted in 195. Any threshold in 195? Answer is no. There is no threshold. What is the rate at which TDS needs to be deducted? At the rates in force. What is the meaning of rates in force? The rate under the act or the rate under the treaty, whichever is beneficial. So there is no rate prescribed, there is no threshold prescribed. You have to determine the rate according to the act versus treaty. It is applicable at the time of payment or the credit, whichever is earlier. The only thing is that the sum should be chargeable to tax. TDS need not be deducted on the sum which is not chargeable to tax. the TDS needs to be deducted only on the sum which is chargeable to tax. So as I said, for business profession, you need to look into section 911 and the treaty article is 5714. For salaries, we have discussed 912 and the treaty article is 15. For dividend, you have 914, interest you have 915, royalties and FTS you have 916 and 7. And accordingly, you have to look into the treaty article for the chargeability as well as the tax rate. So the sum should be chargeable to tax. Specifically in case of sale of immovable property, when a resident buyer is making payment to a non-resident. So then in that case, on what portion you have to deduct the TDS, whether on the entire sale consideration, the answer is no. Because that is not the sum chargeable to tax. So then you will ask how the buyer will determine the sum chargeable to tax. So buyer will have to determine the sum chargeable to tax depending on the details given by the seller. But most of the time detail will not be given by the seller. So then the buyer needs to approach to the tax officer, or the seller needs to approach to the tax officer for the lower deduction certificate. For the lower deduction certificate, the approach has to be made to the tax officer. So under 195, the payer can approach, under 197, the payee can approach to determine the sum chargeable to tax for the lower deduction or nil deduction certificate. Also, in case of the non-resident payment, you also need to have the remittance certificate, which is 195(6) provision, which says that 15 CA, 15 CB needs to be obtained. Whether or not sum is chargeable to tax, you need to obtain 15 CB. So you have part A where the remittance does not exceed 5 lakh. If the remittance exceeds 5 lakh, then you have to obtain, and it is chargeable to tax, you have to obtain 15 CA plus 15 CB. If the remittance exceeds 5 lakh, 15 CA plus 15 CB. If it does not exceed, you have to fill only 15 CA. If you are obtaining lower deduction certificate, only 15 CA. Where the remittance is not chargeable to tax, then also you need to file 15 CA form. So it is very, very important that you first look at the taxability and then you look at under the act as well as under the tax treaty, and then you decide upon the tax rate, and finally you should be very careful about the compliance part as well, that you are complying with all these provisions in terms of the filing the 15 CACB, because if you do not file, there is a huge penalty of 1 lakh rupees. So there's a huge penalty which is given for the non-filing of 15 CA and 15 CB as well. So that also you need to be careful. Also, you have to file, you have to deduct the TDS under, the 195 provision. So again, that is very important. Also, these days there are a lot of substance requirement which needs to be fulfilled. So there is GAR, there is principal purpose test, there is multilateral instrument. All that needs to be also taken into consideration before deciding upon the final taxability, that you fulfill the substance requirement or not. So that's all from my side. Thank you so much.
Thank you, ma'am. Thank you for such a wonderful and guiding session, ma'am. Can we take some questions?
Sure.
Someone has asked whether the income earned outside India should be shown in ITR.
Yes, it needs to be for the resident, not for a non-resident, or as particularly for resident and ordinary resident, not for not ordinary resident.
Okay, ma'am. Thank you, ma'am. Second is, from where do we get details of tax treaties?
On the income tax portal itself, you will find a section tax treaties.
And can you explain in brief business environment?
Business environment.
I don't know. The question is quite incomplete. I felt so.
Yeah, possibly, but not related to tax per se.
Okay, ma'am. Thank you, ma'am. Thank you, ma'am. I would like to express my deepest gratitude to you for enriching us with such a technical topic. Your willingness to share your knowledge and experience has been truly invaluable, and we have honored to have you as our guide and as a mentor. Thank you for your precious time, ma'am. Now, as we have next session, so let's move on to the next topic for the day. We are running short of time, so I will directly hand over to Praveena Oswal to take forward the session.
Thank you, Kamna. From being international, we are moving to basics of charitable trust. After government specified some amount to be spent on for the CSR, the importance of trust is increased very much. So now many CS or want to know about the charitable trust and its taxation. For that purpose, we are having CA Preeti Darod, who is a fellow member of ICA and in practice for the over period of 20 years. She has extensive experience in direct and indirect taxation. She is partner with KPB and Associates and a trusted advisor to the numerous corporate and in non-corporate entities in the field of taxation. Preeti has offered valuable guidance to various not-for-profit organizations regarding regulatory and taxation concerns. Thank you very much for Women and Young Member Committee for choosing this wonderful topic. And now it's dice is yours, ma'am. CA Preeti Darod.
Thank you very much for giving me this opportunity today to share and present my views on taxation of charitable organizations. I hope my screen is visible. Can someone confirm?
It is visible and voice is also clear.
Okay. Sorry.
Actually, presentation is not in slideshow mode.
Okay.
Ma'am, please unmute yourself. Okay.
Hello, everyone. Today, the topic that is given to me is the basics on taxation of charitable trust. Charitable trust and institutions have played a very important role in all these years, over the years, and thanks to the Income Tax Act and the various provisions that are there, making the issues in taxation all the more complicated day in as the years go by. Income Tax Act provides relief to the taxation of the income of charitable trust, but in the recent times, in the last 2 to 3 years, there have been so many amendments to the provisions relating to charitable trust in spite of, if you see in the Income Tax Act, there are the minimum provisions that are applicable to an entity could be to charitable trust. It's only section 11, 12 and section 13, the major sections that are applicable to a charitable trust. But the number of amendments that these provisions have gone through in the last 3 years makes a person really think twice before advising anyone on any issues relating to a trust. It's in these amendments have always been introduced in the name of trying to plug the loopholes, but it's really doubtful whether they are actually plugging the loopholes or making the law more complicated and difficult nowadays for charitable institutions to run and do the charitable work. So these are the different types of institutions, different types of different forms under which a charitable institution can be formed. It could be in the form of a society, which is registered under the Societies Registration Act, or it can be a Section 8 company, wherein registration is required under the Companies Act 2013, or it can be in the form of a trust, an AOP, wherein registration under Maharashtra is required under the Maharashtra Public Trust Act. Charitable purpose has been defined under Section 215 of the Income Tax Act. It's an inclusive definition which says it lists down around 6 to 7 different activities that is considered as charitable. Relief of the poor, education, yoga activities, medical reliefs, running of hospitals, preservation of environment, preservation of the monuments, or the last point, advancement of any objects of general public utility. In this case now, this advancement of any object of general public utility has been so litigative that what is actually being covered under this, there is a proviso to Section 215 wherein it says that if the charitable activity involves carrying of any trade, commerce, or business, in such a case, that activity will not be considered as a charitable activity unless and until it is carried on along with the activities of the other. It is just a moment. Yeah, it is carried out along with the activities of the major activity that is there of the trust. Second condition that is there is that it should not exceed 20% of the total receipts of the trust. So if say for example, I'm having an old home age wherein I'm running a old age house, and to have the activities, they are manufacturing any handloom products, and that handloom products are being sold. The income that is collected from such handloom products are being utilized for the advancement of the old home age entity that is there. If the officer is of the view that the entity is running a business, the sale of the handloom products is a business, and the collection is more than 20% of the total income that entity is earning, in that case, the entity might end up losing the exemption that it is getting under section 11 and 12. Income of charitable organizations is broadly, major part consists of contributions, donations that are being received from either from individuals, government grants, non-government grants, or from other charitable organizations. Income can also be in the form of income that is derived from the property of the trust. In case of contributions, there can be two types of contributions, either corpus donations or voluntary contributions. This is just giving a brief of the entire flow of how the income that is received is to be taxed under the provisions of the Income Tax Act. We'll be discussing more exhaustively in the next slides. For corpus donation, it is always not considered as a taxable income under section 11(1)(d), provided there are certain conditions that the corpus that is received has to be invested in one of the modes that are specified under section 11(5). So section 11(5) of the Income Tax Act has given certain 7 to 8 different modes in which a trust can invest the amounts that are received under corpus. However, if the amount is, again, another thing, that investment that is there has to be specifically earmarked and identified that this is towards the corpus. It cannot be a mixed investment. It cannot be an investment towards the corpus as well as towards voluntary contributions or any other amount that has been set aside. It has to be specifically identified. If it is not identified, it will not be considered as a corpus donation. There are other conditions that in case the corpus donation ceases to remain invested in any of the following years, then too that corpus donation will be taxed as an income. In case of voluntary contributions, 15% of the total contribution is allowed as an application. You can say it is kind of a standard deduction that is being given by the Act to charitable trust. So if your income is 100 rupees, 15 rupees will be given as a deemed application, as an application towards charitable activities, and it's only the remaining 85%, that's the minimum amount that you have to spend in a particular year. If the entity, the charitable entity, fails to utilize the 85%, then the amount that falls short of 85% becomes taxable as income in that particular year. However, the Income Tax Act also gives relief that in case 85% of the income is not being able, the entity is not being able to utilize in that year, it could be for any reason, either that amount has not actually been received as a donation, someone has only promised that I will be giving you that donation, or he has, say in case of a religious trust, usually they have these options for carrying out, the religious activities, and someone is promised that I'll be giving 1 lakh rupees for this, but it's at the end of the financial year, that amount has not yet been received. And what if it has been received in the next year? If the amount itself is not received, it is not possible for the trust to spend that amount because that money is not available with the trust. In that case, there are two options available, either under section 11(1)(a), explanation 1. It allows the trust to set aside or to accumulate such income for a period of 1 year. For that purpose, the trust has to file a form, that is form number 9A, before the due date of filing the income tax return. This form 9A is kind of an intimation the trust is intimating the AO, the assessing officer, that look, I have not received this money, and for that reason, I am going to utilize this money in the next year or in the year in which I received the money. If the trust is not able to utilize due to any other reason, not basically for not receiving the money has been received, but for any other reason it's not being able to utilize it, then to under the explanation to section 11(1), the amount can be set aside and it can be utilized in the subsequent year. However, if the trust fails to utilize the amount in the next year, then that income will be taxable in the next year as a deemed income. There is another section, section 11(2), wherein it allows the accumulation of the income for a maximum period of 5 years. That amount has to be utilized by the trust in the coming 5 years, but it has to identify the purpose for which it is accumulating. It has to be very clear and specific. There is a form 10 that has to be uploaded by the trust, which has to be uploaded before the filing of the income tax return. And in the form 10, the purpose for which it is setting aside the amount, either it could be for constructing an hospital, or for construction of an educational institution, or it could be for medical help, or it could be for any reason, whatever it has to specify in the form 10. And then that amount has to be utilized only for that specific purpose. Again, that amount that has been accumulated has to be utilized within 5 years. If it is not able to utilize within 5 years, it will become taxed in the 5th year itself. In the year in which the 5th year gets over, the amount gets taxable. And there are other conditions that it has to be invested in the forms or in the modes that are mentioned in the section 11(5) is also applicable to section 11(2). So this is what I have already explained, that what if section 80, what is 85% of the income cannot be applied for charitable or religious purpose. One of the conditions is that this income has to be compulsorily applied in India. That is this what the section 11 states, that the amount has to be utilized for charitable purpose or for religious purpose in India. The option to file the form 9A has to be exercised before the expiry of the time allowed under section 139(1). Earlier, in the earlier years, always up to March 22, this form 9A was allowed to be filed up to the date of filing of the income tax return. However, the budget 23 has now changed this. The Finance Act 2023 has now made it compulsory to file this form 9A 2 months before the filing of the income tax return. So for a charitable trust where the due date of filing the income tax return is 31st October, at least by 31st August, the form 9A has to be uploaded in order to avail the benefit and to take it as a deemed application. However, recently there has been a circular number 6 on 24th May 2023. Please read that as 2023, wherein accumulation will not be denied. The circular has mentioned that even if you're not able to file the form 9A by 31st of August, but if you are able to file it before the due date of furnishing the return of income or before the actual uploading of return of income, such accumulation will not be denied for the purpose of taking the tax exemption. Section 11(2), which allows accumulation for a period of up to 5 years. It can be for a lesser period, but the maximum period which is allowed is 5 years. There are certain conditions, however, that any income, the amount that is accumulated, if it is donated or paid, credited to any other trust, which forms of trust are getting covered over here? It can be any institution which is registered under section 1023C, that is any hospitals, any educational institutions, or any other trust which is registered under section 12AA or the new section 12AB. In that case, such deemed income will become taxable in the year in which such amount has been paid to the other trust. Such deemed income will then be taxed at the maximum marginal rate of 30% under section 115 BBI, unless the trust is getting dissolved. And the AO, in such a case, the AO might allow that such accumulated income can be transferred to any other trust. Under no other circumstances, this amount is allowed to be utilized as a donation to any other trust. However, it is only being allowed to being utilized in a direct manner. So, for example, if I am having a trust and I'm about to complete 5 years and I'm in my 5th year, and if I don't utilize the amount of money that I have accumulated, and I decided to give it to Tata Memorial Trust, which is a trust which is registered under section 12AB of the new section of the Income Tax Act. In that case, I would be losing the exemption, and the amount will become taxable in that year. However, if I directly donate that amount to a person which is suffering or suffering from cancer, the reason why the Tata Memorial Trust is basically set up, or if I directly donate it to the person to carry out his treatment, in that case, only the accumulation, the exemption will be allowed. These are the conditions. Section 11.3 states the different conditions for which applicability of section 11.2 is there. Some of the conditions I've already briefed you about, that it has to be utilized only for the purpose that you have mentioned under Form 10. So in Form 10, if it is mentioned that this amount of 5 lakh, say 5 lakh rupees, will be utilized for medical purposes. However, it is being utilized for educational purposes. In that case, we are violating the section 11.2 and it will be treated as an income. If the amount that is accumulated ceases to remain invested in the modes of that are mentioned in the section 11.5, or if it is donated to any other trust, or if it is utilized for any other purpose other than religious or charitable purpose, in that case, it will be losing the exemption. It will be taken as a deemed income in that particular year. Earlier, under the old provisions up to March 22, the accumulation was allowed up to 5 years, and if on the completion of the 5th year, I am not able to utilize the amount, then the unutilized amount would be taxable in the 6th year. However, these provisions have now changed, and from AY 22-23 onwards, AY 23-24 onwards, the amount becomes taxable on the completion of the 5th year itself and not in the 6th year. Any contribution that is made to another trust with a direction that that amount has to form part of the corpus will not be treated as an application of income. So say, for example, I am receiving certain amount as a corpus. So for that particular trust, it becomes exempt under section 11(1)(b). Now, if I as a trust utilize that corpus in donating to another trust under the directions that this amount also has to form part of the corpus, in that case, that amount that has been donated will not be treated as an application of income. Even in case of amounts that have been set aside under section 11(1)(a) or under section 11(2), that is amounts that have been accumulated for future utilization. If any amount is being donated out of that accumulation to another trust on the instructions that has to be towards the corpus, it will not be treated as an application of income. Explanation 3 to section 11(1)(a), which has been introduced by Finance Bill 2021. According to that, this section 40(a)(ia), section 40(a)(3), and section 40(a)(3)(a), which comes under the head business income and which is applicable only if I'm having income from profits and gains from business or profession. But this explanation 3 has now made it applicable even to charitable trust. So if I am not having any business income, in spite of that, all these 3 provisions are applicable. 40(a)(ia), which relates to TDS deduction. If I do not deduct TDS on the expenses that have been set out under section 192, in that case, on the various sections that are there under section 192, in that case, 30% of the amount is being disallowed and it will be treated as an income. So if I am paying professional fees of 50,000 rupees without deducting TDS, earlier, in the earlier provisions before March, up to March 2021, that amount was allowed as a deduction, but from 1st April 2021 onwards, 30% of that amount will be disallowed as an expenditure. Section 40(a)(3), which is about any expenditure which is incurred more than 10,000 in any modes other than an account pay check or an account pay draft or an online mode. Any payment made in a particular day to a particular person in excess of 10,000, in that case, that amount is disallowed as an expenditure. This section now is become applicable to a charitable trust also. Also section 40(a)(3)(a), wherein in a particular year, I have incurred an expenditure, but I have not paid the amount. In that case, since I have already incurred the expenditure, I have taken the benefit of the exemption. In the subsequent year, if I end up paying that person more than 10,000 in modes other than an account pay check, an account pay demand draft, or the online mode, in that case too, the amount will become taxable in the year in which the payment is made. So being a charitable trust, however, provisions of a business income is getting applicable over here. Explanation 3A of section 11(1)(a) gives certain relaxation to religious trust. So in case of a property under trust which includes any temple, mosque, gurudwara, church, or any other place which is notified under section 80G2. Any voluntary contributions received by such entities or by such religious organizations for the purpose of repairs or renovation. So the person who is donating is specifying that this donation has to be utilized towards the repair or renovation of such temple, mosque, gurudwara, church, or any such place. Then as a trust, I have got the liberty to treat that voluntary contribution as a contribution towards the corpus of the trust, and therefore claim the exemption under section 11(1)(d). This has also been introduced from AY 22-23 onwards, new provision again. However, there are certain conditions to treat such voluntary contribution as a corpus donation, that amount has to be utilized only towards the purpose for which it was given. So if it is given to for the building up of a new temple, it has to be seen that it has been utilized only for the building of the temple and for not any other purpose. Secondly, it has to be invested in the modes that are specified under section 11.5, and such an investment is separately identified and not mixed up with the common investments. In case any of these conditions are violated, then explanation 3B of section 11.1a makes such voluntary contributions which have been treated as a corpus donation as income in the year in which the condition has been violated. So earlier what used to happen, that any trust who would receive a corpus donation would claim that donation as exempt income, and then later on use that amount for any other charitable purpose or for the purpose of donation to any other entity. So every year the trust would take a double deduction. First, when receiving the income, it will not offer that income as taxable because it is a corpus donation. It is treated as a corpus donation and hence tax exempt under section 11.1a. Second, it would utilize that amount as an expenditure towards the 85%, that is the minimum application that the trust has to do, and claim the exemption again over there. So therefore, to curb such practices of the trust, section 11.1d came out with some mandatory conditions that became applicable from AY 22-23 onwards. These conditions, which I have already briefed you all earlier, that it has to be specifically, amount has to be specifically being earmarked as corpus donations. No amount can be utilized from such corpus donations to be donated to any other trust. It has to be specifically earmarked, and it has to be invested in the modes under section 11.5. This is Schedule J of ITR 7, wherein the details of such corpus donations have to be given, the details of where the amount has been utilized, the amount that has been received during the year towards corpus donation, and where it has been applied, and whether it has been invested in the modes under section 11.5. So this is a new schedule. Schedule J was there earlier also, but this new bifurcation was introduced in the last year. That is in 21-22. Schedule R, which is a reconciliation of the corpus amounts that are appearing in the balance sheet and the amounts that are mentioned over here in Schedule J. This new schedule, Schedule R has been newly introduced. This is applicable for the income tax return that would be filed for AY 23-24 onwards. This is a reconciliation between the corpus donation. Hello. Hello. A reconciliation towards the corpus donation that is appearing in the balance sheet and the corpus donation that is appearing in Schedule J. Explanation 4.1 of 11.1a says that where any amount is applied, amount which is received towards the corpus, it cannot be treated as an application of income unless in the year in which it is applied, it will be taken as an application in the year in which the amount has been reinvested in the modes that are mentioned in the section 11.5. Similarly, explanation 4.2, which states that in case I have obtained a loan for the purpose of utilizing for charitable or religious purpose. So in the year in which I am utilizing the loan, it will not be treated as a utilization. However, in the year in which that loan is repaid, it will be treated as an application of income. So for example, if I'm receiving, say in year 1, I have received 10 lakhs of donation, which I have treated it as exempt under section 11.1d. If in year 2, out of the 10 lakhs, I am utilizing 5 lakhs towards the corpus. In year 2, the amount that has been utilized towards charitable purpose will not be treated as an application. If in year 3, out of that 5 lakhs, I am again reinvesting an amount of 3 lakhs. I am again the corpus investment that I have liquidated. I'm again investing. I'm restoring back that investment in year 3. Then that 3 lakh rupees will be treated as an application in the year 3. There have been new conditions that have been imposed by Finance Act 2023, wherein it says that the benefits of application will be allowed or will be given only in the year in which such corpus investments have been restored. However, there's again, the condition is that the amount that have been utilized from the corpus, it is not violating the conditions of section 40AIA, 40A3 or 40A3A. Similar conditions have been introduced for loans and borrowings also. So when I am utilizing, if I have received any loan of say 10 lakhs, out of that loan, I am utilizing 6 lakhs of rupees towards charitable organizations, towards charitable activities. In the year in which the 6 lakhs has been utilized, it will not be considered as a utilization of income. In the third year, if I am repaying the loan of 6 lakh rupees, then in the third year, it will be treated as an application. The application is restricted only to the amount of repayment of loan. So if the repayment is happening over a period of time, say it's distributed to 2 to 3 years. So in those particular years in which the amount is being repaid, it will be treated as an application of income. These are again the new disclosure requirements that has come up in ITR 7. Schedule A2, details of loans and borrowings need to be given. How much was the opening balance as on 1st of April 2022? How much loans or borrowings have been taken additionally during 2022-23? where that loans and borrowings have been applied, and when the amount has been repaid, and the year in which the amount has been repaid, and then the closing balance as on 31st March 2023. So this is a new schedule that has been come up in the ITS 7, which you all will be, you all have to fill up from this assessment year onwards. Again, new provision that has been come up by Finance Act 2023. Explanation 4(3) to section 11(1). So earlier what happened to curb the loophole of trust taking benefit of the 15% exemption that is available to all the trust. So say for instance, there is trust A, which has received 1 lakh rupees. Now out of that 1 lakh, I will set aside 15% and utilize only 85%. So 85,000 has been utilized as in the manner of donating to another trust, say trust B. Trust B, when it is receiving that 85,000, it will utilize only 85% of the 85,000 that is received, and it is utilized in the manner of donating to another trust, say trust C. So in that case, what is happening is each layer of trust that is receiving the donation is claiming the 15% exemption. And due to this, to curb this loophole, Finance Act 2023 introduced explanation 4 subclause 3, wherein it said that if as a trust, I am donating the money to another trust, in that case, the 15% exemption that I used to get earlier, I will be losing that exemption. I have to, and that 15% will become taxable as an income in case I am not utilizing as a direct charity. So out of 1 lakh rupees, if I have donated the entire 1 lakh rupees, 15,000 will become taxable and I will have to pay tax on it at the maximum marginal rate of 30%. This new provision is applicable for donations that are made up from 1st April 2023 onwards, and not for donations that have already, one trust is already given to another trust up to 31st March 2023. So this is one example which I have set out. 10 lakhs rupees is being donated. In that case, only 8,50,000 will be treated as an exemption and 1,50,000 would become taxable. The donor trust will always end up paying 15% of the amount that it has donated to the another trust. Explanation 5 to section 11(1)(a). So over here, what is to happen if, say, I as a trust have income of 100 rupees, but I have spent 110 rupees. Now that the differential 10 rupees, that excess 10 rupees that I have spent would be utilized by the trust in the next year, wherever there is a shortage of utilization. To curb such practices, explanation 5 was introduced, wherein it no longer allows the carried forward of such excess application to any of the succeeding years. Section 11(1)(a) says that in case there has been any transfer of a capital asset, in that case, under the normal provisions of the Income Tax Act, any sale or any sale of capital asset would always attract capital gains tax. However, being a trust, the provisions to capital gains tax do not apply to me. Only provisions of section 11, 12, and 13 are applicable. for a trust, the income under the various heads are not, the income is never classified under the various heads of income, and therefore that amount or the capital gains that I have earned would not be taxed as a capital gain. It will be taxed under section 11. However, if I am utilizing that amount towards purchase of a new capital asset, it will be deemed as an application. The net consideration amount, that is the amount that I have received after deduction of expenses, if the entire net consideration has been utilized for acquiring a new capital asset, in that case, the capital gains amount would be, it will be treated as a deemed application. What if I have not utilized the entire amount towards purchase of the capital asset, the new capital asset? In such case, the excess amount that has not been utilized, the difference between the capital gains, the difference between the cost of the new asset and the cost of the previous asset would be taxed as a capital, would be taxed as income of that year. New explanation that was again introduced in by the Finance Bill 2022. According to that, from 1st April 2021 onwards, it was introduced retrospectively. From 1st April 21 onwards, if I have made any provision, say as an for audit fees, provision for audit fees has been made on 31st of March. However, the payment is always made after the audit is done in the next year. In such case, my deduction, I would be allowed as a deduction only in the year in which the actual payment is happening, and not in the year in which the provision has been made. In case where a trust is losing the exemption due to any of the specific reasons, in that case, how would the income be taxable? The specific reasons for which I can lose the exemption is either I have not filed the return of income within the due date, I have not got the books of accounts audited even when I was audit was applicable, I have not maintained the books of accounts as per Rule 17AA, or if I am running a business and my income from business is more than 20%. If in such a case, I am violating any of the conditions, I will end up losing the exemption under section 11. In that case, the income is computed in the form of the trust will then be considered as an AOP, and the expenses that I have incurred towards the charitable purposes. Such expense has to be done in India. It has not to be a capital expenditure. Such expense is not from the utilization of amount from the corpus. It is not from any loan or borrowing, and it is not in the form of a depreciation of any asset. Only that expenditure is allowed as a deduction. Again, provision of section 40AIA, 40A3 and 3A would become applicable to such expenditure, and the balance amount would be taxable in the hands of the trust as an AOP, as an association of persons. Section 115 BBI, again introduced from this assessment year onwards, AY 23-24 onwards, wherein specified income would be taxed at a maximum marginal rate of 30%. Very harsh provision that has been introduced, because against that specified income, the trust will not be able to claim any deduction against any expenses, any allowance, or any set-off of any losses under any other sources of income. The specified income, which is taxable under section 115 BBI, could be either it could be any accumulated income which has been set aside under section 11(1)A, but the trust is not able to utilize the amount within a period of 1 year, or any amount that has been set aside under section 11(2), but due to the violation of the conditions, I have not been able to utilize it. In that case also, the amount that has been accumulated will be taxed at the maximum marginal rate. If the amounts had been utilized for the benefit of any specified person. Specified person has been defined under section 13, wherein the promoter of the trust, the trustee of the trust, the director of the section 8 company, or any relative of such promoter, trust, or director, or any entity in which they are having a substantial interest, or a substantial donor. A substantial donor is a donor which has made donation up to 50,000 till date. It is not per financial year, but right from the date the trust was incepted till date, if I have donated more than 50,000 rupees, I become a specified person for the trust. And if any amount has been utilized for the benefit of such specified person, the trust will lose the exemption under section 11, and the entire amount will become taxable at MMR under section 115 BBI. If the amounts that was supposed to be invested under section 11(5) have not been invested in those modes, then too the amount will become taxable under 115 BBI. So if the income of the trust is 10 lakh rupees, 15% is the deduction which I get, 1,50,000 is a deemed application, out of which again 5 lakhs I have utilized. Balance 3,50,000, which is unutilized, will become taxable at the maximum marginal rate. Friends, if you see the new utility of ITR that has come in, even it is not even allowing the basic exemption limit of 2.5 lakh rupees that was earlier available to a trust as an AOP. So any amount, say even 1 lakh rupees is remaining. Earlier that 1 lakh rupees was being below the basic exemption limit of 2.5 lakhs. No tax was applicable on that. But the new utility that has come up, it is covering that 1 lakh rupees under the new section 115 BBI, and tax at maximum marginal rate of 30% is being levied under 1 lakh rupees. This is really very surprising, because the basic exemption limit, the benefit of the basic exemption limit is being taken away from the trust in spite of it, it being an association of person. Statement of donations, this has been introduced by since financial year 21-22. As a trust, I have to file statement of donations in form 10BD every year by 31st May of the next financial year. So for financial year 22-23, the due date was 31st May 2023, and the details of the total donations that I have received. That is the name of the donor, the address, the PAN, and the amount that it has donated. Has to be uploaded, was supposed to be uploaded by 31st of May. Within 15 days of the uploading of 10BD, 10BE was being generated, which has to be downloaded, and that 10BE form was to be provided to the donor. On the basis of the ARN that was mentioned on the 10BE, the donor can claim the deduction under section 80G. That ARN had to be mentioned in the ITR, the income tax return of the donor. Only if the ARN is mentioned, then only the donor was eligible to claim the deduction under section 80G. So this is also a new provision, a new filing that has been introduced since last year, since financial year 21-22, and a new compliance that has to be taken care of. There is a late fee of rupees 200 per day in case the Form 10BD is not filed by 31st May, subject to the maximum amount, that is the maximum donation that has been received. That is the upper limit up to which the late fee has been set up. Again, there is a penalty under section 271K. Penalty amount ranges from 10,000 to rupees 1 lakh, where the trust fails to upload Form 10BD. 10BD is an online form which has to be uploaded on the income tax portal, and 10BE is to be downloaded within 15 days of filing the 10BD. So in case the trust fails to upload the 10BD form or fails to provide the donor the 10BE form, the 10BE certificate, in that case, the AO can levy a penalty of 10,000 or up to maximum of 1 lakh rupees. Registration process is also newly introduced. New section 12AB, which came in 2021, wherein earlier the registration was, once registration was granted, there was no requirement to renew the registration. The registration was a lifetime registration that was granted. This new section 12AB now requires that the registration has to be renewed every 5 years. So over and above the assessment, this is a kind of a new assessment that the commissioner would be taking or looking into the books of accounts of the trust for the last 5 years, where the amounts have been utilized, whether the amount have actually been utilized for charitable purposes, for the purposes for which the trust has been formed. So a new, even existing trust have to apply for re-registration under section 12AB. Any new trust also has to apply under section 12AB. So these are the different categories of trust: existing trust, new trust which has already commenced activities or not commenced activities, a trust which has been granted provisional registration and the period of 3 years is about to expire, or a grant which a trust which has been given regular registration and the period of 5 years is about to expire, or in cases where there has been any modification in the objects. These are the various clauses or various conditions under which the registration application has to be applied under section 12AB. An already existing trust has to apply under Form 10A. Again, this form is an online form which is to be filed on the income tax e-filing portal. The last date to file this was 31st of March 2023. This date has now been extended to 30th of September 2023 by circular number 6, which came out in May 2023. For old trust, there would be no inquiry. The commissioner would, as it is, renew the registration for a period of 5 years, and such renewal order has to be given within 3 months from the date of application. In case of a trust which is applying for the first time, a new trust, in that case, there is a different procedure for cases where activities has commenced and cases where activities are not commenced. In case where activities have not yet commenced, again, there is the circular number 6 has come out with a new provision that the registration will become applicable from the year in which the application is made. So earlier, what used to happen, if I have made an application up to 31st March 2023, the registration was applicable from AY 24-25 onwards, that is nearly after 1 year onwards. However, circular number 6 now states that it will become effective from the previous year in which the application is made. Similarly, for a trust for which the activities has not commenced, the order for registration has to be granted within 1 month from the date of the application, the registration that would be there would be a provisional registration for a period of 3 years. This provisional registration has to be renewed either 6 months prior to the completion of the 3 years, or it has to be renewed within 6 months from the date when the activities are commenced. In case of a new trust, the application is done in Form 10AB as compared to Form 10A, that is therefore already existing trust. Provisional registrations is granted without conducting any inquiry or asking for any documentation. However, when the trust is applying for a renewal or for the permanent registration of 5 years, in such case, it will be subject to inquiry, wherein the commissioner can ask for various documentations, the activities the trust has conducted, the investments the trust has made, so as to satisfy himself that the actual charitable activity is being conducted and no violation of provisions of section 11 or 12 is happening. So these are the different types of registrations and the time limit within which the trust has to apply for registration. Failure to apply for registration. In case the trust is not able to apply by the extended due date of 30th September, in that case, there is an exit tax that is applicable under section 115 TD. The tax is calculated on the basis of the fair market value of all the assets that the trust is holding in its balance sheet. It's the fair market value and not the book value that is considered. The amount of tax is the maximum marginal rate, is taxed at 30%, and the most stringent condition is that tax has to be paid within 14 days from the end of the previous year in which the failure or the violation is happening. So in case of an educational institution wherein I'm having 2 buildings, I'm running a school and I'm having 2 buildings, it's a very old property. But say I have the trust has forgotten to renew its application. In that case, the market value of those 2 buildings will be considered for the purpose of calculating the rate of the amount of tax that has to be paid, and again that has to be paid within 14 days from the end of the previous year. What are the specified violations which can lead to the cancellation of registration? In case the commissioner or the officer is of the view that the activities being conducted are not genuine, or they are not in compliance of the requirement of any other law. Any other law over here can be any law that is applicable to the trust. So as a Section 8 company, any provisions of the Companies Act that are getting violated. As a charitable trust, any provisions of the Public Trust Act is getting violated. Or if there has been any application of any income has been applied for purposes other than charitable purposes, or when the application for re-registration or fresh registration is made on the basis of any false contention. In such case, it can lead to cancellation of the registration and the trust will lose the exemption available under section 11 and 12. These are again some other conditions. If I am having running any business which is not incidental to the main objects of the trust, or the income from the business is exceeding 20% of my gross receipts, or if I am applying the income for any private religious purpose, or it is being applied for any particular religious community, in that case, it can lead to cancellation of the registration. These are the other conditions wherein it can lead to losing exemption under Section 11. Form 9A, which has to be filed before a due date of filing a return of income, is not being filed, or Form 10 is not being filed within the due date of filing the return of income, or if ITR 7 is not being filed within the due date, that is the extended due date of 31st December, or where Form 10B and 10BB, that is the audit reports, are not been filed within the due date, that is 30th of September. In that case, the trust will lose the exemptions. Books of accounts, Rule 17AA. Rule 17AA has notified some 15 to 16 different books of accounts which has to be maintained at the registered office. In case it is not able to maintain at the registered office, the trust has to intimate the jurisdiction officer the place where it would be maintaining the books of accounts. As an auditor, this the reporting has to be done in Form 10B or 10BB as to the place where the books of accounts are being maintained. This is also a new clause that has come up in the audit report. Earlier, this clause was not applicable. It was the auditor had no such responsibility of reporting where the books of accounts are being maintained. So here, friends, we have to be very careful in case the books of accounts are being maintained at the by the accountant at his office. In that case, you have to immediately inform the officer that the books of accounts are not being maintained at the registered place of business, but at the new address, which is the accountant's place, the accountant's office. Earlier, up to last year, only there was one common audit report, that was 10B, which was a 4-page audit report. However, from assessment year 23-24 onwards, they have now classified, they have brought in a new audit report, that is 10B and 10BB. So for trust or charitable organizations having income up to 5 crore, Form 10B has to be filed. In case of trust who is receiving any foreign contribution or it's having any application of income outside India, 10B has to be filed. In any other cases, 10BB has to be filed. These are the due dates within which the forms has to be filed. I have already discussed these due dates. Thank you very much for giving me a patient hearing.
Thank you so much, ma'am, for such a wonderful seminar. I would really like to express my heartfelt gratitude to your esteemed speaker, ma'am. So inside, you have given such a basic of charitable trust, detailed, in-depth knowledge to us. Your willingness to share your knowledge and experience has been truly invaluable, and we are honored for your guidance, ma'am. I would also like to extend my thanks to technical team, the behind the scene heroes who work tirelessly to ensure that the webinar runs so smoothly. But most importantly, I want to thank you and our participants. Your presence, your questions, and your engagement have breathed life to the seminar. Your thirst for knowledge and willingness to explore new ideas are what drive us organize such events, and your active participant has been helping us in growing more and more. Once again, my heartfelt thanks to all of you for making the webinar a resounding success. I would like to forward to our thoughts crossing in future. Thank you, ma'am.